So the owner came to me and we discussed that they have 12 employees whom he wanted to purchase medical cover for. So I told him the options that were available. So first, we said that we need to look at the three components of medical insurance. So we have the risk, we have the claims, and we have the hospital network. Risk is the bearer who pays the claims that come from the hospital. So if the insurance, we have something called fully insured, where the insurance company takes care of all the three components. We say this is fully insured. I also told him there's another option that we call self-funded, where he could take the risk aspect and then give this money to an insurance company that takes care of the claims and the hospital, but the risk remains with him. I will explain the pros and cons of a fully insured and a self-funded. But this particular client chose the fully insured, where the insurance company takes care of all the three components, that is the risk, the claims, and the hospital network. So once we agreed on the model, now I asked the owner whether he is comfortable paying the premiums upfront, which is normally what most insurance companies do. He said no, because this will affect his cash flow. So we had to explore options where this business will not be affected by the cash flow. So I gave him quite a number of options. Option one was where now the employee would come in and chip in to assist pay the premiums. How is this done? They agree where the employer pays a certain portion and the employee pays a certain portion, so that they ensure the cash flow for the business is not affected. Another option is whereby the employees pay in full the premium through the employer to the insurance company. So the employer acts as a conduit where all employees will pay, then the employer remits the money to the insurance company. So here the employees pay 100%. Another option was the employer pays and then asks the insurance company if they can accept installments. So this business owner said they're not comfortable paying the installments way because the insurance wanted them to pay through what they call IPF. This is where by the business pays and then a monthly deduction is done with a small interest for that. So after exploring all these options, this particular client chose a model whereby he pays 60% and the employees pay 40% within the first year. And then the second year, if business goes on well, they could do 80, 20, and maybe the third year, the employer would do 100%, again, based on how the business will perform. So we agreed that the employer will pay 60% and the employee, will pay 40%. This will not affect the cash flow for the business owner because the employees will chip in, but this is within the first year. So there are various ways that a business organization can look into how to pay the premium, and again, this is dependent on that particular organization. So we look at various ways to help this firm.